the gold cycle will start, and it will be one of the most important historical breakouts we're going to see in the history of the metal. And if that happens, the high beta version of gold is silver, and I think silver is going to break out, and it won't just retest the prior highs. It's going to likely go much higher than that. And so, how do I find leverage without using debt, but really looking for smart ways to allocate capital of myself, my clients, and family to then to really express that view in the markets, where if silver does break out, I really capitalize on this. And so, to me, this is absolutely critical.
In a recent discussion with Mike Maloney, Tavi Costa from Crescat Capital delved into the intricate dynamics of the gold cycle and shed light on silver's role as the high beta counterpart to gold. Costa expressed strong confidence in the imminent commencement of a new gold cycle, which he deemed a significant breakout in market history. Costa highlighted the historical performance of gold to underscore his point. Between 1968 and 1980, gold exhibited an impressive average annual increase of plus 27.4%. Subsequently, from 1985 to 1996, it saw a more modest rise of plus 2.53% per year. However, from 1999 to 2011, gold's annual increase surged again, averaging plus 18.4% per year during this period. This analysis yields an average yearly rise of plus 16.1% during the bullish phases of the gold cycle. Moreover, Costa underscored the close correlation between gold and commodity cycles, suggesting that an upswing in commodity prices could drive higher gold prices. Turning to silver, Costa identifies it as a high beta version of gold, suggesting that it has the potential to surpass previous highs. In agreement with this perspective, U.S. investment bank J.P. Morgan forecasts silver to reach $30 by the end of 2024, driven by the Federal Reserve's potential cuts in interest rates and the decline in U.S. yields. According to Trading Economics, silver is expected to trade at $22.35 per troy ounce by the end of this quarter, based on their global macro models and analysts' expectations. Recent market movements have seen silver prices experience fluctuations, notably dropping to around $22.5 per ounce, marking their lowest level in over a week. This decline coincided with investors reassessing their expectations regarding the timing and extent of Federal Reserve rate reductions following the release of crucial U.S. non-farm payroll data, which indicated a still resilient labor market. Despite these short-term fluctuations, Costa underscores the critical importance of silver as an asset in the years ahead. Join us as we delve into insights shared by Tavi Costa. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I think smart people that make a lot of money in the markets are the ones that identify big macro trends and build vehicles to invest in those ideas. And there are so many ways you could do this. You can just start by buying silver, or you can just actually build a mining company, invest in mining companies. There's so many different ways to skin the cat. And when I stumbled into this chart, I was immediately, thinking, my brain just couldn't stop thinking about, what do I do to participate in this? Because I believe strongly that the gold cycle will start, and it will be one of the most important historical breakouts we're going to see in the history of the metal. And if that happens, the high beta version of gold is silver, and I think silver is going to break out, and it won't just retest the prior highs. It's going to likely go much higher than that. And so, how do I find leverage without using debt? But really looking for smart ways to allocate capital of myself, my clients, and family to then to really express that view in the markets, where if silver does break out, I really capitalize on this. And so, to me, this is absolutely critical. For those that haven't seen this chart yet, it's just basically showing the quarterly candles of silver going back to the 80s and 70s. And you can see, the prior highs of the 70s and 80s, and the Hunter's Brothers. And then you have later that you have in 2011, another high that we retested that created a double top, and we've had a large decline coming from that. And now we've been sort of consolidating in this below this resistance that goes back to 2011, which is what the line is suggesting. And if you ask me, we're going to break out and go much, much higher. And if that's the case, you have to ask the question, how do I expose myself to that breakout? And That's why I spend most of my time thinking. To be quite honest, often people say that silver prices have underperformed for so many decades, and we still have not retested the Hunt brothers peak. And to me, that's just a reason to be interested in the asset. And the whole reason is the fact that it hasn't yet outperformed other things, and it's so off the radar. And
Yeah.
if gold is off the radar, then silver is that in steroids. And so, to me, it's why I think it's such a critical asset to own the next years, and why it's so relevant to my thesis and yours as well. And so you have basically from Incrementum AG, Roni shared this data with me. I've been looking at this data for some time now. It's basically looking at the commodity prices going back to the early 1900s. What is fascinating about this, Mike, is the fact that we've had throughout history three real inflationary decades, meaning where inflation runs hotter than historical standards. Those were the 1910s, the 1940s, and the 1970s. Obviously, we lived through inflationary forces throughout the whole history, but those particularly decades had other issues that really reinforce those problems even further. But what is important here is that during those 3 decades that are the first ones where you have the arrows in this chart, you also had a commodity cycle. So 3 inflation decades, 3 commodity cycles, and then the fourth one, that is the fourth arrow there, is going back to the early 2000s, in which we didn't really see an inflationary era during that time. But what we saw was China having a manufacturing boom. They were building their economy, and that drove the commodities market in a large way, the demand side. And today, I would argue that we're seeing both things at once. We're seeing the inflation cycle at the very early stages of one. And the second thing is the G7 economies, not China only, but G7 economies really doing a manufacturing revamp to reduce reliability with other authoritarian regimes. And so countries or even businesses are going above and beyond to, instead of doing a cost efficient approach, they're changing that to secure their logistics. And so that's creating a boom of commodities that we're yet to see in a much bigger way. And that ultimately, because this is the whole idea here, ultimately drives gold prices. Because I've never seen a gold cycle that wasn't driven in tandem with the commodity cycle too. So they're all involved in the same idea.
Total gold demand reached a record high last year and is anticipated to continue expanding in 2024, particularly as the U.S. Federal Reserve moves towards cutting interest rates, potentially bolstering prices, according to the World Gold Council. In 2023, gold consumption surged by approximately 3% to 4,899 tons, buoyed by robust demand in the opaque over-the-counter market and sustained purchasing from central banks, as detailed in the WGC's comprehensive annual report. Costa underscores the significant influence central banks wield over the price of gold. Despite holding record amounts of gold presently, historical data reveals that central banks have allocated much larger percentages of their balance sheets to gold, reaching up to 80% during the late 1970s and early 1980s. Moreover, Costa argues that inflation is not obsolete, but rather a structural issue poised to accelerate again in the near future. According to Statista's projection, the U.S. inflation rate is expected to be 2.3% in 2024, followed by a slight decrease to 2.1% in 2025, and stabilization at 2% for the subsequent years, 2026 and 2027. Let's get back to the interview.
It's the whole point of when you're thinking about buying an asset for the next 5 to 10 years, the biggest idea is to find something that is not crowded, in other words, uncrowded, and at the same time that has the very high potential for changing that dynamic in a large way, driving capital into that asset, and then driving the prices a lot higher. I think gold it fits into that whole thesis. And the main reason is because you have to look at two pools of capital. And here you're looking at one of them. That is the fund managers, the pension funds, and all these types of investment strategies that are completely under allocated towards gold. As you can see here, 71% of those advisors own 0 to 1% allocation in gold. And I think the more even striking point about this chart is the very last portion there, where it shows that 0% of them own 10% or more. Yeah. So, I'm going to guess Mike owns more than 10%. So, I don't think they surveyed him. or myself, but certainly this is astonishing. And when you look at central banks as the second pool of capital that is very critical to potentially come in and change the price of the asset, meaning gold, you looked at historically what's been happening with gold purchases by central banks. Yes, we're seeing record amounts today, which is really positive for gold investors. But throughout history, they only own less than 20% of their balance sheets in gold. Back in the 70s or late 70s, early 80s, they own close to 80% of their balance sheet in gold. And so there is a potential for a change of allocation in the metal across those central banks internationally. And I believe it's going to happen. So those two pools of capital are yet to come in and change that in a large way. And it will create, in my view, a gold cycle. This is why I get so excited about buying gold related businesses, because I think that's ultimately where we're going to be making money and probably generational wealth opportunities in the next 5 to 10 years. Been in this 18-month range where the commodity prices have been kind of going sideways. The Fed is cheering on, saying that they won the war against inflation. Essentially, they pivoted. They changed their stance to from hawkish to now dovish. And when I look at that, and I look at the price of commodities, I don't think they've accomplished anything. I mean, the underlying issues of natural resources being so undersupply have not been fixed at all. I mean, we're in the business of investing in these companies, and access for capital remains very difficult. And so there is a reason why, despite the positioning that comes, can be quite cyclical in markets, you're still seeing this range where commodity prices have not left this range for 18 months. And if you ask me, we're probably going to go through this range and break out and then reaccelerate on inflation. And this chart pairs well with the next one, because when you look at an analyst, if you go to the next chart, they're all expecting in record amounts that inflation is going to decelerate. That's what this chart's telling you. It's how many of those investors, Bank of America does this research where they ask their fund managers, how many of you think inflation is going to decelerate? And guess what? It's record levels today. They all think inflation is over. And what if it isn't? What if this deglobalization problem intensifies again and the container index goes up a lot more? We have a second wave there. Or what if commodity prices break out from that range that I've been referring to? There's so many what ifs when I have a consensus view in markets that is often wrong, saying that inflation is dead. And it's not true at all. It's very structural and most likely will accelerate again very soon, in my opinion. And we're probably going to get into the second wave of inflation.
The recent decision by the Federal Reserve to maintain interest rates had a bearish impact on gold prices. However, analysts at Herias anticipate that central bank interest will persist in supporting gold prices throughout 2024. Additionally, they suggest that silver demand from the solar industry is poised to surpass forecasts once more. What factors will have the most significant impact on the precious metals market in the coming years? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.